Your business structure affects how much you pay in taxes, the paperwork you need to file, and your personal liability. Choose carefully because while you may convert to a different structure, it could also result in tax complications. I'm John Dickson, a tax consultant with Henssler CPAs Advisers, and welcome to our newest series, the Small Business Minute. We get a lot of questions about S-corporations versus LLCs, but technically, the question is S-corporation versus a partnership. Unlike an LLC or a C-corp, an S-corp is not a type of business entity. The S-corp designation refers to the way a business has chosen to be taxed under the Internal Revenue Code. For small businesses, the correct question is, should I be taxed as an S-corporation or a partnership? We usually suggest clients form their entity as an LLC and then make the election to be taxed as an S-corp. The exact LLC definition varies slightly from state to state, but usually LLCs offer more flexibility in the way they are managed and usually have fewer record-keeping and reporting obligations than corporations. An S-corp is popular among small business owners because it has many advantages, including limited liability, no tax at the corporate level, and pass-through taxation like a partnership, but with no self-employment tax exposure. The S-corp entity also comes with trade-offs. One disadvantage is being limited to one class of stock. This makes S-corporations less flexible than partnerships with the allocation of income between partners. As an S-corp, all the income, losses, and credits are passed through the business and reported on the owner's individual tax returns. The net income from the S-corp are not subject to self-employment taxes. Instead, the S-corp owner is only required to withhold the FICA taxes on their salary paid by the S-corp. In 2019, both the employer and employee FICA amounts are 7.65% on the first $132,900 in salary earned. Salary over this threshold is subject to 1.45% for Medicare taxes until the salary exceeds $200,000 for single taxpayers and $250,000 for joint taxpayers when the rate increases to 2.35%. These rates, employer and employee when combined, is basically self-employment taxes. The tax exposure for flow-through income of partners and partnerships. The IRS typically has an issue with S-corporation owners who pay themselves an artificially low salary and then take substantial distributions from the S-corp, thus reducing the amount of Social Security and Medicare payroll taxes paid. Because of this, you should be paying yourself a reasonable salary. But what is a reasonable salary? The IRS considers a reasonable salary to be what you would pay a third party to perform the same job. We suggest maintaining documentation to support your reasonable compensation. This might mean hiring a third party to provide a reasonable compensation report, or simply printing industry-specific data from a salary guide or trade association. Once you have determined a reasonable salary, there is no reason why you shouldn't take additional money from the corporation as distributions. As your company grows and your job description changes, just make sure to adjust your salary as necessary. A tax advisor with experience in small business taxes should be able to help guide you in decisions in these areas. If you'd like a review of your small business, Henssler Financial and the tax experts at Henssler CPAs Advisers are here to help you along the way to your success. I'm John Dickson, and thanks for watching.